So this video will discuss PSERS pension options. First, we'll discuss how to decide whether to take the lump sum or not. Second, we'll discuss how to decide which survivor option is most appropriate for your unique situation. See, in the work I do as a retirement planning specialist, many of the clients that I work with are PSERS participants. I also grew up around PSERS. My dad and my mom are both PSERS participants. My brother's actually an active PSERS participant now too. So I'm fairly familiar with the program, and I thought putting this video together may benefit those of you who we haven't had the chance to meet individually yet. So we'll examine PSERS benefits a little bit more closely by looking at Jane. So Jane is currently age 60. She's considering retirement at the age of 62, which for her will be at the end of the school year in June of 2024. So the first step for Jane will be to see a projection of what her pension benefits will be in June of 2024. So she'll do this by either logging into the PSERS member portal, or she'll use the generic retirement calculator found online too. So the PSERS pension estimate figures you see on the screen here are based primarily on Jane's age, her spouse's age, her years of service, her service class, her income, her projected final average salary, and some other minor factors as well. Now, Jane's first important decision will be whether to take the lump sum or not. So on the bottom left-hand side of the screen, you see a category called withdrawing no money. So these are the pension options that do not have a lump sum affiliated with them. So for example, in this category, if she takes the maximum option, she'd receive an annual pension payment of about $64,000 per year for life. Or generally in practice, that'll be broken down as a direct monthly payment into Jane's bank account. So the main reason why she would consider this option versus options with the lump sum is that this is just the highest fixed monthly payment that she'll receive. Now on the other side of the estimate, category called withdrawing all of your money on the right-hand side of the bottom. So here the maximum amount is reduced to about $48,000 per year, or she'd take an approximately $16,000 a year pay cut. So why would she do this? Well, this option, the $48,000 per year, also comes with a one-time lump sum of $245,000 that Jane can take and do what's called a direct rollover into her traditional IRA account. If she processes it correctly as a direct rollover, there's no tax when she takes the lump sum from PSERS and puts it into her traditional IRA. More specifically, PSERS will send it directly to her IRA for her benefit. She'll never actually touch the money, and there will be no tax implications. There's tax implications when she pulls it out of her IRA, but not up front when it goes in there. So reasons why Jane may consider taking the lump sum option. First off, with the lump sum, it provides more flexibility. See, with the lump sum, Jane can pull out whatever amount she actually needs. And any amount she doesn't need, she can keep it in the account invested, and over time, it may grow. Second reason why she may consider the lump sum option, inflation protection. See, the fixed monthly pension, it's a great benefit to have. However, it doesn't have a cost of living increase. So there's no way for Jane to know up front when retiring what that fixed monthly amount is actually going to buy her 5 years into the future, 10 years into the future, 20 years into the future. But she can bet it'll probably buy her a whole lot less due to inflation. So with taking the lump sum, that can provide a nice balance. The lump sum, especially if she doesn't need to touch it right away, she can allow that to be invested. Over time, it provides growth potential, and it may help offset inflation risk within the context of Jane's overall retirement planning. Another reason she might consider the lump sum option is potentially more for beneficiaries. When she takes the lump sum and puts it into her own IRA account, she can name beneficiaries to be whoever she wants. It no longer has anything to do with the pension system. Now that's just her own personal money. So if Jane's married, she may name her spouse as the primary beneficiary. If she has kids, she may name her kids as contingent beneficiaries. So now that money is protected, separate from the pension system, and any money left in the account will go to those beneficiaries. So weighing the pros and cons of her options within the context of her own unique retirement planning situation, Jane chooses to take the lump sum. Now, the lump sum may be completely inappropriate for you. What's important to do is first build a comprehensive retirement plan and then make the PSERS decision based on what's appropriate for your unique situation. Okay, so now that Jane has decided that the PSERS pension option with the lump sum made the most sense for her and her family's unique retirement planning situation, the next step is to determine which survivor benefit is best. So the first option you see on the screen there is called the maximum. So with the maximum option, Jane will receive about $48,000 per year for as long as she lives. However, once she dies, survivor gets nothing. Now, because she took the lump sum, she could name the spouse as the beneficiary on the lump sum account, the IRA where the lump sum went, so that's still there to protect the spouse. But in terms of the monthly pension payments, with the maximum option, when the pension recipient dies, they stop entirely. There's nothing else coming from the pension. Now next, you see option 1. So option 1 on the screen there shows instead of $48,000 a year, it would pay approximately $45,000 a year. So another way to look at it is for taking option 1, there would be a pay cut of about $3,000 per year. Now in exchange for taking that pay cut, a death benefit would be provided to Jane's beneficiaries, assuming there's still a death benefit left. You see at the bottom of the screen there, it says option 1 death benefit is $713,000. Now, if Jane were to die right away in retirement, tragically, unexpectedly early, her beneficiaries would receive that amount. However, each pension payment that Jane receives reduces that death benefit such that after the first year of payments, the death benefit would be reduced to about $668,000. That's $713 minus 45. After about 16 years of payments, that whole $713 would be exhausted to the point where there's no death benefit left. And after about 16 years, by the way, because Jane's retiring at 62, she's only in her late 70s at this point. She's not even close to normal life expectancy yet. So on average with option 1, if the person lives even close to normal life expectancy, beneficiary will receive nothing. Next is option 2. So with option 2, as you see there, the benefit amount is about $42,000 per year. That's a pretty severe pay cut from where we started at 48. But in exchange for that $6,000 per year pay cut, if Jane dies first, her spouse will continue receiving that entire $42,000 per year. It's what's called the 100% survivor option. The next option on the screen there, called option 3, about $44,600 per year. So the pay cut's still pretty steep, around $3,000 a year. But in exchange for that, if Jane dies first, her spouse will receive 50% of the amount she was receiving, or half of the $44,600. Or the spouse, if Jane dies first, will get about $22,300 per year. So for Jane to determine which of these survivor options makes the most sense for her and her family's overall unique financial situation, first she's going to ask herself the question, well, if I were to die unexpectedly and tragically early in retirement, what would happen to my surviving spouse? Now, to see the long-term implications of that scenario on her surviving spouse, she's going to build what's called a retirement cash flow statement. And you see the retirement cash flow statement on the screen here. So this retirement cash flow statement has many uses. It answers some of the most important retirement planning questions, such as when can I retire, or how much money do I need to have saved to retire, or how much income will I need to pull out of my investment accounts each year to fill the gap between expenses and fixed income sources. It's also a very useful tool for stress testing undesirable scenarios, such as one spouse dying unexpectedly young, and that's exactly what we'll do here. So what we've done here is created 3 different scenarios. In each of the scenario, Jane dies unexpectedly early on in retirement. Jane dies 5 years into retirement. When Jane dies 5 years into retirement, expenses are shown declining by 20%. One spouse left, expenses expected to decline somewhat. Here they're shown declining by 20%. Now we're going to look at, depending on which survivor option Jane took with her pension, what financial position was her surviving spouse, John, in 30 years later. In the first scenario you see here called the maximum scenario. So with the maximum pension option, remember there's no pension survivor benefit for the spouse. When Jane dies, the pension stops entirely. And you see that reflected in the cash flow statement here. When Jane dies in 5 years, Social Security benefits stop entirely. The pension stops entirely too. Now on the bottom right-hand side, you see a margin of safety. The margin of safety is a projection for how much John will have left in 30 years under these conditions. And the conditions mapped out here in the cash flow sheet start with relatively conservative assumptions such as 5% return on investment, for example. However, things could certainly work out worse than planned here too. So the margin of safety is how much buffer there is in John's plan for him to avoid running out of money. So what we see here is that there's not much of a buffer for John to avoid running out of money. If Jane takes the maximum option, it's not exactly a conservative plan if she was to die unexpectedly young. Now the next scenario we see on the screen here, option 3, the 50% survivor option. So if Jane takes this pension survivor option, the situation for John long-term looks quite different. You can see her Social Security benefits will still stop when she dies, but now the pension continues. It is cut in half, but it still continues. As a result, the margin of safety for John in 30 years is now a little over $1 million. Healthy margin of safety there for things to go wrong and John still to stay financially secure. The third scenario is taking PSERS pension option 2, which is the 100% survivor option. So here, when Jane dies, Social Security stops, but the pension continues exactly as is, unreduced. Now the margin of safety left for John at the end is actually over $2 million. So of course, if we're stress testing scenarios where Jane dies unexpectedly young, the highest survivor benefit option is going to play out best. But what happens in the more likely scenario where Jane lives to around normal life expectancy or maybe a little bit beyond, into her mid to late 80s or maybe in the 90s? Well, that's what we'll look at next. Now next, for Jane to evaluate what PSERS pension survivor option is most appropriate for her and her family, she'll need to consider the more optimistic scenario that she lives a long time. So this screen here will show the cost of each of the survivor benefits Jane has available to her through PSERS, assuming she lives for 30 years, so she's collecting her PSERS pension from the age of 62 to 92. Now under the first option, as we covered earlier, the maximum option, there is no survivor benefit. Under those conditions, Jane will receive about $47,800 per year, but when Jane dies, the pension stops entirely. So as we discussed earlier, if Jane dies unexpectedly young, her spouse John may be left in a tough spot. Now in the next scenario, option 3, the 50% survivor option, you see there is a meaningful cost there. Jane takes a pay cut in her pension in terms of a reduced benefit of about $3,100 per year. So if Jane's collecting the payment for 30 years, that really adds up over time. It's almost $100,000 worth of pay cut, and that's not counting interest that she could have earned along that money on that money along the way too. However, in exchange for that pay cut, now the spouse is in a much better financial position, as we discussed earlier. Now the third option, option 2, which is the 100% survivor benefit, the pay cut's even steeper. The pension's reduced by almost $6,000 per year, about $177,000 of projected pay cut over 30 years, not including interest that could have been earned on the money along the way. But the spouse is left in an even better position. So which survivor option will Jane ultimately choose? Well, of course, that'll depend in part on their overall financial situation. Other factors may come into play in their decision too, such as, well, one, for example, health. So let's say, for example, that in this case, John and Jane, they're very financially comfortable. They have good retirement savings. John has his own large pension. It's actually larger than Jane's. They have no debts at this point. And John's also far less healthy, to the extent that John and Jane both mutually agree that it's very likely Jane will outlive John. So given the facts of that case and the way they were laid out, John and Jane may mutually conclude that the maximum option makes sense for them. They may say that, well, taking a pay cut of, whether in the example we saw earlier, whether it's $3,000 a year or $6,000 a year for the larger survivor benefit, it wouldn't really make sense for them, and in a way it would be like buying insurance that they don't really need, because in the very unlikely event that Jane does die unexpectedly young and before John, which certainly could happen, in that undesirable and unlikely scenario, John would still be okay, based on the way that the facts of the case were just laid out in that example. Now, not that that would always be the right thing to do under those circumstances. You may come to a very different conclusion with the same set of circumstances. That's just in that specific case what John and Jane thought was appropriate based on their own personal preferences. Now, let's say a very different case, for example. John and Jane here, they're not in as strong of a financial position. They still have a lot of debts. They don't have much saved outside of PSERS. And John is actually significantly more healthy than Jane in this case. Well, given the facts of that case, they might consider leaning heavily towards one of the larger survivor options, potentially the 100% in option 2, just given the way the facts were laid out there. Again, not that that would necessarily be the appropriate thing to do under those circumstances in all cases. That's just what John and Jane came to the conclusion in their specific case was most appropriate for them based on their personal preferences. So the key point from these two brief examples, and really from the whole video, is that the PSERS pension decision, it's irrevocable. Once benefits start, you can't change your mind later on down the road, and the implications of your decision are potentially very significant. So what we did in this video, putting Jane in a position where she's making a PSERS decision within the context of her overall retirement planning, so it's very well informed, it's probably a good thing to do. So if you'd like to discuss your PSERS decision within the context of your overall retirement planning, complete the form at the top of the page and I'll be in touch.